Hello, in this presentation we will enter an adjusting entry related to the short-term portion of a loan payable into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We'll first take a quick look at QuickBooks and then jump into Excel and enter the data there. When considering QuickBooks, we're looking at those adjusting entries, those things done at the end of the time period, the planned adjusting entries in order to make the financial statements correct for the end of the time period on an accrual basis. In this case, we're looking at the loans payable account, and we have a couple items in this loans payable account, and a common thing that needs to be adjusted at the end of the time period when making the financial statements is to break out the current portion and the long-term portion of the loan. Oftentimes it's easier to go through the process within the accounting department and record the information to the loans to one account and then make the adjustment at the end of the time period in terms of how much of that account is current or how much of that account is going to be payable within the next year, and therefore is a current portion. That's what we'll do here. In QuickBooks, we can try to do that without doing journal entries. Typically, even within accounting software, we would have adjusting journal entries and need to know debits and credits and need to enter journal entries. It is possible to enter this information, however, using registers and go to the loan register and enter the related adjustments. We're going to work this with journal entries in Excel, so let's take a look at Excel now. Here we are in Excel. We are on a different tab than we've been working with prior. We're in the Adjusting Entries tab for February. We're going to have our worksheet. This is going to be a typical kind of adjusting entry worksheet that we will be using. That will include the unadjusted trial balance, our adjustments then, and the adjusted trial balance. This type of worksheet can be really useful because it helps us to separate the adjusting process from the normal journal entry process and keep separate in our mind, as we should, the normal journal entry process, the normal stuff that happens throughout the month, all of the transactions that happen, and those things that need to happen at the end of the month. And you might want to think of it as a separate accounting department or a CPA firm or someone separate doing this adjusting process. This can help to keep the process distinct within our minds. So this adjusting worksheet, the unadjusted trial balance is going to be what is received from or gotten from what is the end product as of this point in time, the end of the month, in the normal accounting process. So all we're doing here is taking these accounts and putting the balances in from our prior worksheet. In order to see that, we can see that this is going to be where it's coming from in terms of the formula, the trial balance tab for the February AK5. I'm going to go to that tab. That's going to be this tab here, and scroll all the way to the left, and there it is there, AK5. So we're just drawing over the ending balance numbers that we ended up with as of the end of the month into our adjusting entries worksheet. I'm going back to the adjusting entries worksheet, and here we have this. Now we're going to enter our adjustments. Instead of posting them, we're going to record them into this adjustment column. In other words, we're going to have a similar adjusting journal worksheet here in terms of the location that we enter the adjusting journal entries. But instead of posting them to the general ledger, we're just going to post them to this quick little worksheet, and that'll give us a quick idea of here's the beginning balance, here's the activity, here's the ending balance, and it'll be in relation to all the other accounts. This type of worksheet works great when we only have a few adjustments because it gives us that quick check and see what happens, and we can tick and tie everything out and read what is going on. So it's perfect for an adjusting entry type process. It doesn't work if there's too many entries. So if it doesn't work when we're talking about the entire month of information, because we need much more detail than just this column, because there's going to be way too many transactions. For example, in the cash account, if we have 20 transactions, this short worksheet doesn't give us the detail that we need. That's why we need the general ledger. But when we're just talking about 10 journal entries or less, a worksheet like this works really great. That's why it's typically going to be used in the adjusting process. So we're going to go through here and look at these adjusting processes. Once we get the adjusted trial balance after these adjusting journal entries, then we'll make the financial statements from the adjusted trial balance and see how that is put together. So let's take a look at these. We're going to first do the loan payable, and that's going to be this account. So we're working on the loan payable account, and what we're really looking at in this section is to break out the loan payable between the long-term portion and up here the current portion. So that's going to be the case that the current portion are going to be the amounts of payments that are going to be due within 12 months, within the next year, as opposed to those payments that are going to be due longer period of time than that. When we look at the loan payable in the books, some companies will group all their loans together in one account, even though it's going to be backed up by multiple loans. Some companies will have multiple accounts for each particular loan and track them separately in a separate account. Whatever the process is, we need to go in there and break it out. It's a typical journal entry that will happen at the end of the month, because it can be difficult for us to, every time we make a payment, break out the current portion and the long-term portion at that point in time. We often leave that till the end of the month in order to do that. To see the detail in this loan account, we can take a look at the general ledger. We've just pulled over the general ledger from the prior balance in order for us to analyze it and then figure out what our adjustment should be. So here's our loan payable. It started off with this 22 and then we added 50 to it. We are going to basically be saying that that 72 there is all one loan. We made some payments here on the loan, and then we took out another 5,000 increase in the account. This then is actually a second loan. So we're going to be saying here that there's actually two loans that are making up this 74,878. One is for 72,000, which was put in place in two entries, but has been updated. The latest loan is 72,000. The other is 5,000. This is a separate loan that we put on the books when we purchased, I believe, equipment. So we're going to look at this loan first, this short-term loan, and consider the adjustment. Now, I just said it was a short-term loan. We're actually going to adjust this all out because it will be all short-term. We do want to look at the terms, however, and think about what the interest is on this and how this all works out. So in order to do that, we're going to look at the amortization table. We're going to look at this quick amortization table here, and then we'll take a look at the longer amortization table for the other loan, the long-term loan, where we'll have a current portion and long-term portion, and consider the types of loans that we can have a little bit. So in this loan, what we're going to have is that $5,000. We're going to say that it is a 6-month loan, which is all current, and it has an interest rate of 6%. So let's figure out first what the future value is going to be. This is a little bit different than the loans we might think of typically, because usually we're going to make payments of principal and interest during the loan. We'll see that on the next loan. In this particular loan, we're not going to be paying the interest or the principal back until the end of the loan. So after 6 months, then we have to pay the entire amount back, 1, the 5,000, and 2, the 6%. That means that we might be thinking, well, the loan, if we're paying back something more than 5,000, should be something other than 5,000. It should be the amount we're going to have to pay back within 6 months. And that's not what we'll put there. We're actually going to put the 5,000, and we'll discuss what interest is a little bit just to get a better idea of why that might be. And to do that, we'll look at the amortization table. This is going to be something that often isn't shown in the loan agreement. We'll have the loan agreement, and we might not get an amortization table. It's something that we might want to put together, however, because it gives us a good idea of what is going on. What we're going to figure out is the future value, and that's going to be the amount that we're going to get back, or we're going to have to pay back at the end of the loan, the 5,000 plus the 6% interest. So we'll calculate the future value here. In order to do that, we're going to go to the formulas, and we're going to do this with the function here. So we're going to go to the function in library and click this insert function. This will help us to navigate through this. If we go through here and we're typing in future value, we want to bring this FV, which is going to be the future value, meaning it's going to be the amount that we have to pay back after we have the $5,000 loan after 6 months at a rate of 6%. So this will help us out. This little dialog box will help us input this information in order to analyze this loan. So I'm going to scroll down just a little bit. We've got the rate then. We'll just put the information into here in accordance with what it's asking for. The rate is going to be, I don't need an equals, it's just going to be that 6%. That, however, would be for a year. Because when we talk about the interest, we typically talk about for a year's time period. We don't want that interest rate for the year, however, we want it broken down into monthly amounts here. So we're going to break it down to monthly amounts by dividing it by 12. So we're going to take that 6% and divide it by 12. That'll give us the monthly rate. Then we have the number of periods here. Now this is a little bit tricky because this is the total number of payment periods, it says. And we're not making a payment until the end. So you might think, well, there's only one because we're only going to make one payment at the end. But we want to use the same formula to compound the interest monthly. So we have to say that it's going to be this 6. We're going to have 6 months that will pass. Those are going to be the number of periods at the interest rate, which will be that 6% divided by 12, or the monthly interest rate. And then we're going to say the payment amount is actually going to be 0. Those 6 payments, we're not going to make any payments. It's just going to be 0 for those payments. And what that's telling the computer is that there's going to be 6 times that we want to compound it monthly at the monthly rate of 6% divided by 12, which would be that monthly rate. And then we want to see what the value is at the end, meaning what we would then have to pay back at the end of the time period if we valued this at 5% at 5,000, 6% interest for 6 months. To do that last piece we're going to need is the present value. That's what the value is, of course, right now. When we took out the loan, it is what it is at this point in time. That's the 5,000. So if we give this information, then we'll see what we have to give back in terms of the payment at the end of the loan. We're going to say okay, and there we have it. If we make this a negative, if we want to make this a positive number, then I'm just going to double click on this and put a negative in front of the whole thing, and that'll basically tell Excel to take that and multiply it times -1, or flip the sign, and there we have it. So what we're saying here is this type of loan, we're going to say that we borrowed 5,000 to purchase this equipment, I believe it was for, and we're just going to pay back 5,152 at the end of the time period. Let's see that one more time in terms of the table and see how this will work. And we're first going to generate our table. We're going to say that the payments are all going to basically be 0 because we're not making any payment until the end of the loan. But we're still going to calculate those payment periods. And then we're going to say that the interest is going to be equal to the $5,000 loan times the interest rate of 6%. But then we're going to divide it by 12 because we want to make that the monthly interest rate. So that's $25. If we want to see that one more time, it's 5,000, and we're going to multiply that times 0.06, 6%. That would be the interest if it were for a year, but that interest rate is, we want it for a month, so we're going to divide it by 12, and that gives us the 25. The reduction in principal, the principal is actually increasing. Typically, this is going to be a principal reduction. Now we're going to say it's increasing because there was no payment. The interest is increasing the principal, and therefore we're going to take the original amount, and I'm going to add this by saying it's going to be this minus this negative number. So now we have the new principal after that first time period, that first month, of 5,025. This will just show how the payment is increasing. We're still going to make a payment of 0 because there is no payment in the second period. This is how that formula is working. Now we're going to calculate the interest, but we're going to calculate it on this amount. So we're going to say, if we had the calculator, it's going to be 5025 instead of 5,000 times 0.06, 6%. That would be for a year, 301.50. We're going to divide that by 12 and get the 25.12. It's still going to show 25 here because we took off the decimals, but it's slightly different. We're going to take this amount principal here. We're going to multiply that times the 6%. And then we'll divide it by 12. So there we have that. Once again, it's going to actually increase the principal by 25. We're going to show that by saying it's going to be equal to this prior principal. I'm going to say minus this number, which will actually increase it by that number to the 5,050. If we keep going through this, we should end up with this number at the end. So let's do this a couple more times and then we'll copy it down. So here's 0 payment. Calculation equals the 5,050 times the 6% divided by 12. Enter 25. This equals the 0 minus the 25, which is actually an increase in the principal. The principal now was 5,050 minus, or that's going to increase because that's a double negative, minus a negative 25, increasing to 5,075. We'll do this one more time and copy it down. Zero payment. Interest equals this 5,075 times 6% divided by 12 months, tab. Reduction in principal is now this minus the 25, tab. We now have a principal equal to the prior principal minus, which is going to increase because it's double negative, the negative 25, giving us this number. What we're going to do now is copy this down. If I copy this down, if I highlight this and copy it down, we'll see if Excel gives us the relative references we need. So I'm going to put my cursor, I'm going to highlight these items, put my cursor right there so it looks like that, not like that, but like that. Scroll down and see if it did what we want. First of all, this, I know this didn't do what we want. It needs to be 0. And this doesn't look right, of course, because what happened, this looks right, but it pulled this down. So we need to make that an absolute reference is what's going to happen. And this looks right, and this looks right. I'm going to delete this and make the adjustment we need to make. So I'm going to say, okay, well, this is this times that. This cell is going to move down as a relative reference, and I don't want it to do that. That is cell U6 or U5. So that U5, I'm going to put a $sign in front of the U and a $sign in front of the 5. So it's $U, $5, and then enter. And now let's copy it down and see if it does what we want. So we'll highlight this. We'll put our cursor right on that square and pull that down. There we have it. We know this still needs to be 0. But this looks like it's doing what we want now. It's taking this number times the 6%. So that looks correct. So I'll copy it down one more time. We'll highlight this and copy it down. And there we have it. So we're off by, it's $1 off. That's rounding. That's okay. And that's going to be our amortization table. The point of this is that we need this amortization table typically to understand what the interest is and know what the short-term and long-term portion of the payments are going to be. There's the $1 that it's off by. I'm going to make that 0. The short-term and long-term payments that we're going to make. Now this is all going to be short-term, but it's only for the 5,000 and not the interest that is accumulating over time, which is of course that 152. Why? Because we haven't yet incurred the interest yet. So we can't record the interest even though it's due within a year until the point in time that we have incurred the interest through using the money. So at this point in time, we don't owe the interest. We will owe it as time passes. So our adjusting entry then is just going to take this amount out of the long-term portion and it's going to transfer it to the short-term portion. So in order to do that, we're going to make all of our adjusting entries as of the end of the month. So we're in A3. We're going to say 228 and we have the long-term interest. It's a credit. We're going to make it go down by 5,000 and therefore we're going to do the opposite thing to the long-term portion, which in this case is a debit. So I'm just going to copy this cell. We're going to put that up top in B3, right click and paste 1, 2, 3. The amount's just going to be for that entire 5,000, that one portion of the loan that is included there. We're going to credit something for 5,000. That then will be the other side, loan payable current portion, which is going to go up by that 5,000. Why? Because these are credit balance accounts. We need to increase it, so we're going to do the same thing to it, which in this case is another credit. So we're going to copy that loan payable in K14, right click and copy. Put that in cell B4, right click and paste 1, 2, 3. Then we'll increase the indentation by going to the Home tab, the Alignment group, and increase the indentation. Then we'll go ahead and post this to the center column, the adjustment column of our account, and then get our adjusted balance. So here's the long-term payable. We're going to scroll down just a bit. It's going to be right there. So right there. So we're in M18. We're going to select equals, scroll up just a bit and point to that debit, and it should bring down this amount. So we're in M18 equals, scrolling up just a bit, pointing to that 5,000. Scrolling up just a bit and pointing to that 5,000, and that brings the balance down from 74,878 down by 5,000 to 68 $878. That puts us out of balance, of course, by the $5,000. No effect on net income because none of the blue accounts or the dark blue accounts, the income and expense accounts, have been affected by this transaction. Now we will record the other side, which will be the current portion. So the current portion is here. We're going to be in our adjusting column. We are in cell M14, selecting equals, and we're just pointing to that 5,000 here. That's going to bring this balance, zero balance, up by 5,000 in the credit direction to 5,000. So in essence, we have taken this amount and we've moved 5,000 of it up here. So here's the amount being decreased. Here's the 5,000 we moved to the current portion. When we create the financial statements from this, then this portion of the loan will be in the current portion and this portion of the loan will be in the long-term portion. Note that we are back in balance and there's no adjustment or no change to the net income or income statement amounts calculated here as revenue minus expenses.